Hi, this is Andy Flippick in Toronto for the week of September the 4th. This week, the Bank of Canada announced that they will be holding the official bank rate at 5%. Now, this hasn't surprised many people, and the talk afterwards was still the main message from the Bank of Canada is that they will be fighting inflation going forward. Now, the Bank of Canada has had to raise rates as other G20 banks have been raising over the past year and a half due to the inflation. The question is, at what cost? For example, in the second quarter of this year, the Canadian economy actually contracted 0.2%. So it could be argued that we're already starting to see the effects of this tightening. Now, it's important to remember going into this inflationary period, we had a 10-year period, basically a decade or more, of virtually 0% interest rates. And what this led to was a lot of businesses and individuals taking on a lot of leverage at ultra low interest rates. Now, if you look at the chart we're showing with the Bank of Canada rate, we have gone from effectively the 1% area to 5% in a year and a half. I mean, this is a stealth rise in interest rates in a admittedly very levered economy. Also showing what's happened to interest rates just over the last couple of years is that both the variable and the 5-year mortgage rates have gone up tremendously. As you can see from the chart, from 2000 to 2003, we've seen the variable rate jump 200% in its cost. As well, the 5-year rate, you can see, has had over a 30% increase in its cost. So over the next couple of years, if rates don't change dramatically, this effect is going to work its way through the entire system and put tremendous pressure on the individual and the economy. For example, when interest rates are raised, it's common under Keynesian theory to say that a rise in rates is deflationary because it raises the borrowing cost, creates higher, takes away from the leverage in the system, and ultimately results in lower prices and a weaker economy. However, when you're in a levered economy, rising interest rates help create inflation. And the examples I just showed where people's mortgage costs are going up, and there's no doubt that the largest expense on many people's monthly expense report is mortgages. So not only have food and energy prices gone up a lot, but so has mortgage costs. So this could cause a very steep drop in the Canadian economy, because when you're levered and you raise rates this quickly, it can create tremendous problems. Now, looking at the housing stock, I saw some numbers today from the Canadian Real Estate Association showing that the average house in Canada is now over $700,000, and that is 8.8% of the average income. Now, so historically, we have seen housing costs at 3 to 4%, 3 to 4 times the average income. So houses are very expensive historically, and it's houses that are backing the mortgages that have been issued. So this is a problem. 70% of our banking system in Canada is residential mortgages. So eventually, with the higher cost of mortgages seeping through the system, one would expect housing prices to start coming down. Remarkably, they've held up very, very well despite the sharp rise in rates. So one of the things one has to be careful for is a greater recession caused by the steep rise in borrowing costs. And if you remember, in economics, there's always a lag between the raising of rates or the policy move and the ultimate effect. So how this affects our portfolio, we only have 20% in risk assets and equity, and our equity fund is primarily US and international big blue chip stocks. So we will not in the portfolio be affected as many others are who have a higher equity weighting if Canada goes into a recession. Thanks for watching.